Okay, we'll take a look now at question 2 in that September-December 20 exam, which was called Calibra. Question 2, as you know, is the ethics question. Sometimes the ethics can be worth about 7 marks. In this case, it turned out to be worth 12 marks, which was much more. It's just the way the cookie crumbles, isn't it? But the approach would always be the same. If you haven't yet, make sure you pause the tape before you listen to the debrief. We're going to have a look at part A and B together, because they really are about the same issue. One's asking for the adjustments, and A and B are concerned, aren't they, with the specific issue around the sale of the apartment blocks. So part A was worth 5 marks, part B was worth 3 marks. So sale of apartment blocks, it does say, doesn't it, specifically that you should make reference to, that you should make reference in the requirement to revenue. That's helpful, but I think we'd have got that. But it also says make reference to borrowing costs as well. So there's a classic instance of where it might be a good idea just to refine your knowledge first. So when we look at this, initially, let's just have a think about what the relevant knowledge would be. In terms of revenue, when you read the scenario, you notice that the customer does not get control of the apartment block until it's all finished, which is obviously also logical. And so that's presumably the time when you should recognize the revenue. The examiner has said don't write out all 5 steps in the revenue recognition model. Well, that's something to take on board. But the key message, isn't it, when you talk about revenue, always try and bring in this word performance obligation. It's a good word to put in. The performance obligation that arises there, of course, is that when you construct an asset for the customer, and that performance obligation, again, would be satisfied when there is transfer of control. And in particular, again, so transfer of control is presumably, again, when the customer is in possession. So they can now walk around the building, say, this is mine. So the customer in possession. Transfer of title, words like that. So you want some knowledge around revenue, and you also want some knowledge around financing cost. This was the reference to IAS 23. Even if you're not sure at the moment what you're supposed to be saying, you can put down the basics, can't you? And what you do know about IAS 23 is that interest is capitalized, in other words, added to the value of an asset, and it's added to the value of a specific asset if that asset is said to be qualifying. If it's a qualifying asset. And when we talk about a qualifying asset is one which will take a substantial time to get ready. So in other words, it's an asset that takes time to complete, usually construct, then when you rack your brains around it, well, it's got something to do, hasn't it, with the different prices that we're given. We can see how that works when we look at the adjustments in just a minute. So those are the sorts of relevant points of knowledge. You don't have to put a heading that says knowledge. I'm just going through my thought process. Application in the scenario, presumably, is that we can only recognize the revenue when the asset is complete. And you'll get the customers have two different payment plans. They can pay 8.5 million in advance, 2 years in advance, or they can pay 9.55 million, I think it is. Is that the correct rate? I think it was, when the asset is actually complete. So if they pay in advance, they're almost as if they are actually lending us money. So the message might be from there that if the customer pays the 8.5 million in advance, the old word you'd tend to use for this is deferred revenue or deferred income. Probably the better word to use now is contract liability. So again, that would be treated as a contract, or recognize as a contract liability. I'll put the adjustments in as we go through just to get your thought process going. So at that stage, the customer would pay debit cash. I'll do this in $1,000, 8,500. Credit contract liability, so which we tended to always in the past call deferred income, 8.5 million. What's going to happen, isn't it, is that over the next 2 years, interest will accrue. So the finance will accrue. They give us a rate. A quick check on your calculator says that if you take 8.5, add on 6%, add on another 6%, you get back to the 9.55 million that they mention again right at the start of the scenario. So what's going to happen is that over the next 2 years, first of all, the contract liability will increase. Normally, something like that, I tend to say it's a finance cost in the P&L. But here's the cunning bit. So if you said finance cost up, you're on the right lines. But in fact, come back to this point here. This interest cost is added to the value of the asset. You met IAS 23, remember, when you studied financial reporting. So instead of charging P&L, the other side is that the value of this contract asset, will increase. You're probably saying, what contract asset? There isn't one yet. Well, it is going to start effectively again when we start to accrue that increase. So the contract liability will increase. The other side is like the building. So I'm going to call it work in progress or inventory. Work in progress will also increase. That's the IAS 23 bit. It's quite hard, isn't it, to get your head round? But we can probably see the maths quite easily. So in the first year, you'll debit work in progress and credit the contract liability with 6% of the original 8,500. 6% of 8,500 is 510. Then in the second year, it'll get bigger again. Debit work in progress, credit contract liability. So compound the interest, 6% of 85 plus 510. Again, if you work that through, that's going to give you 540 in the next year. Finally, at the end of the 2 years, control is transferred and we can recognise the revenue. So finally, after the 2 years, we can recognise the revenue. So, debit, the contract liability, we don't need it anymore. And of course that will be 8,500 plus the 510 plus the 540. We know what that's going to be, don't we? That's the 9,550. Credit revenue, 9,550. And then, of course, when they do their profit and loss account, the work in progress or inventory won't just have this 510 and 540. It'll have all the other construction costs in, and that can be matched against the revenue. But that's not so much what the question is actually about. So I've kind of done the calculation there as we went along. I thought it was easier for you to see. You might look at that and scratch your head and say, well, I'm really going to mess that up. Well, the reality is this, you won't mess it up entirely. You see, I'm sure you're all able to do a bit about the revenue. And I'm sure you get the message about the revenue that you can't book it at the start, which is good. We can all write out the finance cost line, even if you can't work out what it's got to do with the question. There's got to be a mark there, hasn't there? And you could probably have a reasonable stab at the adjustments. I think the only thing might be that many people would have debited P&L instead of debiting work in progress, because frankly that's a really obscure point, isn't it? You know, when they mark it, they have to say how many mistakes did you make, and if your only mistake is to debit P&L instead of debiting work in progress, that's 1 mistake out of 8. 7 and 8 out of 8 wouldn't be such a bad mark. But, you know, if in doubt, if it's complicated, you're not quite sure, stick down the relevant knowledge. No excuse if you don't have that. I can't help you because you have to learn it. Remember to use our flashcards to get that final knowledge sorted out. But application, we'll probably have a reasonable stab at it. That's part A and B. Part C was about the ethics, and again, I don't want to say a huge amount here because people are generally doing fairly well on this ethics. Remember, what you have to make sure is that you are applying the principles to the actual scenario that you are given. That's important. I think one of the blocks in this question is that you read about blockchain, distributed ledger technology, and you thought, well, I, like this person, know nothing about blockchain. And you perhaps said, you don't know what it is. You might know what a block strain is, but not a blockchain. Does it matter? You know, if the question was about a cow, how much do you really know about cows, apart from the fact they moo? So your knowledge of blockchain technology is actually just about irrelevant. And in some ways, it could almost be a disadvantage if you are a professor of blockchain technology, because you go whiffling on about it. The point is, isn't it, is that it's got some sophisticated method of accounting about which this junior accountant doesn't know much, and that clearly raises ethical issues. As always, remember, there is 1 mark in there for just explaining the reference to the ACCA code of ethics. And you're already cooking with gas, aren't you? You're well on the way. Then think about your relevant principles and apply them to the scenario. The most significant principles here you can see are, of course, there's quite a lot in there, isn't there, about professional competence and due care. Because this person, again, lacks knowledge of blockchain. You don't need the knowledge, you just need to complain about the fact this person should get the knowledge, of course, if they don't have it. They lack the knowledge about this blockchain distributed ledger technology. It does actually say as well, doesn't it, that they're newly qualified. And there's therefore again a need for training. And that's what would happen, isn't it, if you were working and you came across something like this. You would say to your boss, look boss, you need to put me on some program again just to try and sort out these technical issues. The accountant looks like they're going to try and cover up what they're doing. So there are definitely some issues in there about integrity. Remember, integrity is umbilically linked to words like straightforward business conduct, which they may not be exhibiting, again, because they're basically, again, attempting to hide or conceal ignorance. Ignorance isn't a bad word in that context. It just means you do not know about it, doesn't it? And so what you need to do is say, I do not know about this. In that case, that's fine. It's fine to have the ignorance and solve it by training. And then, of course, the other one is objectivity. So it's allowing, again, a threat. And in particular, the relevant threat there is, of course, the self-interest threat. And that's where you can bring in the bits, particularly of the scenario. So again, objectivity again is linked to words, isn't it? Like you are reluctant to disagree. But in particular, the self-interest threat there again, because that arises, doesn't it? Because again, the person wants a permanent job contract. And again, in respect of offering, and just let me link that up to, so that's if they have knowledge of the technology. They also want a good reference. And they think they can get the reference by offering this other party, is it Bodoni? Yes. So again, that's where you can talk about the Bodoni contract. You could link that back to the integrity as well, couldn't you? You could also link it, if you wanted to professional behaviour, because doing that kind of thing would lower our standing, our reputation, again, as ACCA accountants. So I think from there, probably, 10 marks is a lot. I'm surprised about that. But I thought we could pick up 6 or 7, and then you would pick up the extra 2, as long as you are occasionally referring to the scenario, and don't write out all the principles and then just let them apply it, so the examiner would take that very badly indeed. There we are. There's some thoughts on question 2.